Hi friends, SEBI categorized mutual funds into these 5 types: equity schemes, debt schemes, hybrid schemes, solution oriented schemes, other schemes. And equity schemes are further classified into 12 types. Present video is about the last one, index fund. Index funds are also known as index tied funds or index tracked funds. Index fund is a vast topic and it is almost impossible to cover entire topic within one video. So I am planning to make near about 5 to 6 videos on this topic. So this is first video on index fund topic, in which I am going to cover the meaning of index fund. Let us start the topic. Mutual funds are generally managed based on two approaches or two strategies. They are active management of fund, passive management of fund. Let us see the first one. If any fund is actively managed, then that fund is known as active fund or actively managed fund. For example, there is one asset management company. Company launched one active mutual fund scheme and the company collected corpus from investors. Now the fund manager of AMC should invest these corpus in the stocks of public limited companies. He invests according to the type of this fund and purpose of this fund. And the AMC maintains a research team. Their duty is to conduct a market research and to identify the opportunities for the investment. So with that valuable information, fund manager has to design a portfolio for this particular fund. Assume that he designed a fund portfolio with the stocks of 70 companies. Now the main aim of fund manager is to generate alpha from his fund. Alpha means what? In our country, there are two stock exchanges now, National Stock Exchange, Bombay Stock Exchange. So in National Stock Exchange, by considering top 50 best performing company stocks, daily Nifty will be calculated. And in case of BSE, by considering top 30 companies, they calculate Sensex. Here Nifty and Sensex, these two are known as market indices. For example, at a particular point of time, this index has given a return of 12% and fund manager is able to generate a return of 16% from his fund. Now the fund returns are 4% extra when you compared with market index returns. This 4% is known as alpha. Thus, fund manager always tries to beat the market index. For that, continuously he monitors this fund portfolio. He decides which stocks are to be purchased, which stocks are to be held, which stocks are to be sold and when. Thus, continuously, actively, he manages the fund. So, this is all about the first strategy. Now come to second point, passive management of the fund. If mutual fund is passively managed by the fund manager, that fund is known as passive fund. Index fund is one best example for passive fund. Index fund concept is introduced by American investor and business magnate Mr. John C. Bogle. There are thousands of listed companies in National Stock Exchange and Bombay Stock Exchange. So it is almost impossible to analyze the performance of each and every stock. There is one saying, too much of analysis leads to paralysis. So AMC doesn't maintain any research team in case of passive fund. Fund manager doesn't create any portfolio by himself. He doesn't buy, he doesn't sell, he doesn't hold the portfolio as per his own analysis. Means he doesn't maintain the fund actively. That is why index fund is known as a passive fund. He believes that it is almost impossible to beat the benchmark, nothing but the market index in long term. So the main aim of fund manager is not to create alpha. His aim is to track the market index. Means in case of index fund is benchmarked with market index. A student copies in the exam now. Similarly, fund manager simply copies the benchmark index. By looking at the name of the index fund scheme, you can identify its benchmarked index. For example, HDFC Index Sensex Fund. So this fund tracks Sensex. Tata Index Nifty Fund. So this fund tracks Nifty 50. ICICI Prudential Nifty Next 50 Index Fund. This fund tracks Nifty Junior. Similarly, you have Motilal Oswal Nifty Mid Cap 150 Index Fund. Motilal Oswal Nifty Small Cap 250 Index Fund. So let us see how this index fund works. For instance, one AMC asset management company launched index fund scheme which is benchmarked with Nifty 50. Company is able to collect corpus from investors. As per SEBI regulations, the fund manager of AMC must invest a maximum portion of corpus, that is minimum 95% of the corpus in the stocks of all 50 companies within the Nifty index. Nifty is the index of NSE, no? First 50 companies with the highest market capitalization are included in this index. So the corpus is invested in the stocks of all these 50 companies. These 50 companies belong to different sectors, no? For example, some companies may belong to banking sector. Some companies may related with auto sector. Some are from FMCG. Thus, by investing in one fund, investor is able to get the benefit of diversified portfolio. Then see the continuation, in the same proportion as in the Nifty 50. Here the proportion meaning you should know. In our example, index fund is following Nifty 50, no? So Nifty index contains 50 companies and NSE gives weightage to each company based on their market capitalizations. Weights will be given in the form of percentage. For example, Reliance Industries weightage is 9.76%. HDFC Limited weightage is 8.31%. If you add all these weights, you will get 100. Assume AMC collected 102 crore corpus from investors by launching one index fund scheme. 2 crore company wants to keep aside to meet redemption requirements from investors, and the remaining 100 crore company wants to invest in these 50 companies. While investing, company has to follow the same weightage. This is known as investing proportionately. Means what? Suppose take Reliance Industries Limited. In total corpus 100 crore. Reliance company weightage is 9.76% now. So 9.76% of 100 crore, that is 9 crore 76 lakh, is to be invested in Reliance Industries Limited stocks. Similarly, with 8 crore 31 lakh rupees, fund manager of AMC should purchase the stocks of HDFC Limited. Not only this corpus amount, in future, if this fund generates any income, even that cash inflows also fund manager has to allot for different companies in the same proportion. So observe the unique feature of index fund. Here, index fund investor, by purchasing one index fund scheme, he is going to invest in the stocks of Sensex or Nifty indexes, no? Means fund investor is going to invest directly in the Indian economy. This is a unique feature of index fund. You know, Sensex contains 30 companies and Nifty contains 50 companies. Means fund investors amount will be invested in the stocks of 30 different companies if a fund is tracking Sensex index. If fund is tracking Nifty, then his investment will be invested in the stocks of 50 different companies. So comparing to Sensex, Nifty gives more diversification benefit to the fund investor. And let us know about the changes in the composition of market index. For example, NSE removed one underperforming company from this 50 companies list. Then index fund manager also should remove the stocks of that particular company from the fund portfolio. How? By selling the stocks to others. Similarly, if NSE includes any profitable company in this 50 companies list, then fund manager also should include the stocks of that particular company by purchasing them from others. So remember, when there is any change in the market index composition, then fund manager has to mechanically replicate those changes in fund portfolio. So the fund index portfolio is just a mirror of market index. Come to the last point. Index fund manager doesn't try to beat the benchmark index. In other words, he never tries to outperform the market index. He is not interested in generating alpha from mutual fund. He always tries to equalize the returns of fund with the returns of market index. If there is any increase in the market index, you can see the same in the NAV of fund unit. And if there is any decrease in market index, same thing will be reflected in the NAV of one mutual fund unit. Thus, the NAV of index fund unit fluctuates according to the ups and downs in the market index. And remember one point, don't think that the returns of index funds and market index will be exactly the same. Generally, you can find some slight differences between these two returns. Even in examination also, a student cannot copy makki ka makki, no? Definitely there will be some difference. Suppose the returns from one market index is 12%. Then the returns from index fund may be 11%. Here the difference of 1% is known as tracking error. So almost in all index funds you can see this tracking error. So my next video is about this topic. So with this I am ending the present video. I hope now you have some brief understanding of what is an index fund. Hope this video is useful to you. Thank you.